What if you could bet on a horse after it's already won a race? Sounds impossible, right? But famous investor Terry Smith thinks that we can do exactly that by investing in companies that have already proven themselves as winners. I came across a fascinating chart from visualcapitalist.com that shows the top 10 largest S&P 500 companies over time. And this got me thinking, what if I invested $10,000 in each of these, quote, winning companies at the end of every fifth year starting in 1995 through 2015, as the chart shows? Would they beat the market over the long run? Now, there were some surprising results, and what I discovered might change the way that you think about your own investment strategy. So to run this little experiment, I used dividendchannel.com, which I would suggest you go and try it out too. Right in the middle of their page, if you click on calculator, it will bring you to their calculator. So in the symbol bar, for example, we'll put General Electric, ticker GE. Start date, as of this chart, it was from a Goldman Sachs report that Visual Capitalist pulled this information from. It was from December 31st of each of those years, every fifth year. So December 31st, 1995 is when we'll put in to match that up. And then as of the recording date, it was April 21st, 2025. We'll hit the chart 10K invested, but if you also wanted to compare, you can compare to the S&P 500 or the NASDAQ or whatever stock ticker you want, as it will show you the growth of $10,000 with those dates you selected and then also without dividends reinvested. And this is where I pulled all the data from for the spreadsheet that I'm going to show you. Don't forget to go to dapperdividends.com and sign up for my free and fantabulous weekly newsletter, where I share an investing thought, the portfolio activity, dividends received, and some stocks about to go ex-dividend. And as always, if you'd like to save a bunch of money on a Seeking Alpha annual subscription, there is an affiliate link below. Now, we won't spend too much time on this spreadsheet, but the idea is that we're comparing against the S&P 500. Why? Because a lot of investment professionals think that it's just the no-brainer option for long-term investing, because with one shot, one ticker symbol, SPY, or the Vanguard is a little bit cheaper, ticker VOO, you're getting the 500 biggest companies in the United States. You don't have to pick anything, and you just set that DRIP, the dividend reinvestment plan, which means when you get paid dividends from the S&P 500, it will automatically reinvest those dividends to buy you that much more of the S&P 500. And you don't even need to sell. You want to hold through all the volatility. Why? Because the stock market has always come back. The stock market has an up and to the right bias because companies innovate, they become more productive, more profitable, they grow, and stock price follows earnings. So they increase their earnings, their stock prices rise. And the beautiful thing about the S&P 500 is it's self-cleansing. The garbage companies, they fall to the bottom and eventually out, and the cream of the crop rises to the top where you get your Mag 7s. So the Goldman Sachs report that it pulled from showed the top 10 companies in the S&P 500 on December 31st at the end of each of these years. But when I put that in, we got January 2nd, 1996. I guess you couldn't buy on the 31st. And then the ending date was April 21st, 2025, which was about 29.32 years. The interesting thing, and probably the most important, is when we start in 1995, only 4 companies beat the S&P 500. It was Philip Morris, which is Altria. Altria ended up changing its name, spinning off Philip Morris International, so it's kind of a mix right there, but 4,253%, just astounding. Procter & Gamble, 1,579%, Johnson & Johnson, 1,419%, and then IBM, 2,072%, beat the S&P 500's total return with dividends received of 1,280%, we'll call it. When we started this experiment at the end of 2000, we see only 2 of 10 companies beat, which was Walmart and Microsoft. Starting in 2005, again, only 2 companies, Microsoft and Philip Morris. 2010, a little better, 3 out of 10. Apple, Microsoft, and JP Morgan Chase beat the S&P 500. And then in 2015, we had a whole heck of a lot of companies beat, which was Apple, Alphabet, Microsoft. Very interesting that you can see how the new world tech stocks really rose to the top. Apple, Alphabet, and Microsoft beat. And then you also had Amazon getting in there at number 7. Berkshire Hathaway, and JP Morgan Chase rounding out the top 6 that beat. But the most interesting thing, going back to when we started this at the end of 1995, first week of 1996, is this light blue box right here. This is how many companies that you would have received 100% of your initial investment back in dividends. So we see for GE, you would have received almost $82 in dividends, but your starting price per share was $58. So just by holding, you got your entire initial investment back for that one share. That almost worked out for AT&T, $38.87 received in dividends, but you would have paid $44.31 a share. So very close. ExxonMobil, Coca-Cola, Merck, Philip Morris International really gave you a lot back. Check that out. The starting price was $30.63. And if you held all the way till today, you would have received $145 just in dividends. Shell was really close. You would have received $79.92 in dividends, but that starting share was $81.88. So very, very close on that. And then Procter & Gamble, Johnson & Johnson, and IBM, but also the S&P 500. Ticker SPY. You would have paid $62.14 for one share of the S&P 500, ticker SPY, and you would have received $95.71 in dividends. Now, out of that list, on average, only 34% of companies a year beat the S&P 500 if you just held and reinvested dividends into both. And what that shows us is even though some of those winners continued to win and beat the S&P 500, picking which ones is really difficult. And math backs that up. According to this Motley Fool article, about 92% of professional fund managers fail to beat the S&P 500 over 15 years. Remember, these are experts with research teams that have advanced degrees, lots of money behind them, all the coolest whiz-bang gadgets and gizmos to help them pick and make the investments, and decades of experience. So if the professionals with their whiz-bang gadgets and gizmos struggle to beat the S&P 500 this much, what chance do us regular retail investors stand? And that's exactly why I've been reshaping my investment approach. As of this recording, this is my current investment net worth portfolio, just my wife and mine, not including any savings account, the equity in our house, 529 plans for the kids' college, any of that stuff. It's just mine and my wife's investment net worth. And we're currently trying to get to an allocation and make this thing idiot-proof, mostly for me, being the idiot that needs the proofing against. We want to get the fund exposure to 85% and the individual stock exposure to 15%. And we're currently at just a shade under 75%. So we have some work to do. This is going to take some time, but we're not in a hurry. And this is a long game that we're going to enjoy getting to that target allocation. And the three biggest funds by themselves are the DFUSX, which is the DFA US large cap company. It's the S&P 500 mutual fund that I'm able to pick in my 401k. Then we also have the Vanguard Value Index Fund, looking for those value companies like Berkshire Hathaway, the big blue chips like Coca-Cola and PepsiCo. And then I like to have that mid-cap exposure, some of the smaller companies. There's a thought out there that mid-cap companies are about to have their day in the sun. When that might be, I don't know. So we allocate 10% to the mid-caps, 30% to the large-cap value stocks, and then the last 60% to the S&P 500, and then all the individual stocks, because I want to scratch that itch of trying to find those high-quality dividend growth companies. So personally for me, I think this 85-15% allocation we're working toward getting to just gives me the best of both worlds and also makes it idiot-proof. So I think the big takeaways here are that the proven winners don't always keep winning, where we showed that only 34% of the top companies beat the market on average in my experiment. That patience pays off. If you hold long enough, especially onto dividend-paying stocks, they can return your entire initial investment through the dividends alone. You shouldn't underestimate how hard it can be to beat the S&P 500 when 92% of professionals can't do it. Having most of your money in low-cost index funds is a really smart approach. And if you enjoy stock picking like I do, I think you should consider a core and satellite approach, where you have most of your money in in broad market funds with a smaller portion that's idiot-proofed in individual stocks that you research carefully. Is there a company that's a winner that you think is going to beat the S&P 500 over the next 10, 15, 20 years? Share your thoughts in the comments below and in this floating little box next to my head. Speaking of those quality dividend growth companies, I shared my watch list of 34 of them. So click that floating little box right there next to my head. And if you do that, I'll tell you which ones they are there.